Welcome to breaking news to trading moves. I mean, imagine handing two retail traders the exact same mathematically proven trading strategy.
Right, the exact same rule set.
Exactly. One uses that strategy to build a thriving, sustainable career in the markets.
And the other blows up their account in, less than a week.
Losing every single dollar of their capital. So why does that happen? Today, we are looking directly at the central question of survival in the markets. Does trading success rely primarily on mastering trading psychology and emotional control, or is a mathematically sound, technically strict trading strategy the true prerequisite for survival?
It's the ultimate debate for anyone trading capital.
It really is. And I hold the perspective that psychological discipline is the paramount factor in a trader's success. Your mindset dictates whether you thrive or fail, completely regardless of the tools you hold.
And I argue the contrasting perspective. A rigorous, predefined technical strategy is the foundational requirement that makes any psychological discipline possible in the first place. You simply cannot build a resilient mindset on top of bad math.
Okay, well, let me lay out why I view psychology as the ultimate dictator of performance here. If we look closely at the actual mechanics of the market, a trading edge is really nothing more than an indication of a higher probability of one outcome over another.
Sure, it's statistics.
Right, it is not a guarantee. Every single moment in the market is entirely unique. I mean, a setup you see today might look exactly like a setup from last Thursday, but the underlying order flow, the specific institutional participants, the exact liquidity profile, it is all entirely different.
Which is why the math matters so much.
But because of this random distribution between wins and losses, a trader who lacks emotional control will inevitably fall victim to behavioral biases, impulse loops, hesitation. You can hand a trader the most pristine, mathematically proven technical setup in the world, and without psychological mastery, they will render it utterly useless.
Because they sabotage themselves.
Exactly. They will exit early out of fear of losing a small profit, or they will hold a losing position way too long out of greed and hope. The mind is the actual battlefield here, not the charts.
Yeah, I come at it from a completely different way. I mean, a concrete technical strategy is the absolute bedrock of trading. I argue that cognitive discipline simply cannot exist without a rigorously defined framework, which professionals often call a trade book.
But the trade book is just paper if you don't follow it.
Well, let me finish. Because without specific quantifiable parameters, such as exact risk percentages, minimum average daily volume thresholds, or, specific bid-ask spread limits, a trader is not actually battling poor psychology. They are simply gambling without an edge.
Gambling is a strong word.
But it's accurate. You cannot psychoanalyze your way out of a mathematical disadvantage. If you do not have precise entry rules, defined profit targets based on technical levels, and strict stop-loss placements, your emotions are totally irrelevant because your structural foundation is flawed from the very beginning. A structured plan removes the guesswork, and that, in turn, removes the emotional burden from the trader's shoulders.
I see why you think the structure solves the problem, but let me give you a different perspective on where trading errors actually originate. Let's talk about the breakdown of a trader in real time.
Okay, let's hear it.
We have documented scenarios of traders who operate perfectly in simulated environments, and they even put together green streaks in live markets where their strategy works beautifully. But then one single mechanical error occurs.
Like a fat finger trade.
Yeah, exactly. Perhaps it's a hotkey mistake where they accidentally double their position size instead of exiting the trade. What happens next is purely emotional. It is a psychological hazard often referred to as crack addict trading syndrome or revenge trading.
Right, the classic tilt.
The trader takes a substantial, unexpected loss. Their psyche shatters, they go on a complete rampage. They start trading tickers entirely outside of their plan. Highly liquid, fast-moving tech stocks like JD, BABA, and MU.
Just completely chasing volatility.
Yes. They choose these specific stocks because they provide instant action, purely out of frustration and this visceral desire to just get back at the market. They describe turning into an absolute savage, abandoning every single structural rule they spent weeks building. That is an emotional failure. The structure was there, but the mind completely discarded it.
I'm sorry, but I just don't buy that sequence of events as a purely psychological failure.
How can you not? They ignored their own rules.
Let me tell you why. Relying purely on emotional restraint in the heat of a sudden market loss is like asking an airplane pilot to fly purely on instinct while flying through severe turbulence.
Okay, I follow the analogy.
When a pilot hits a violent storm, gravity is pushing them around, their inner ears completely disoriented, and their biological instinct screams at them to pull the yoke up aggressively. But if they do that, they stall the plane and crash.
Right.
The autopilot, however, relies entirely on math. It maintains the exact necessary glide path to survive the storm. Those emotional spirals you were describing occur specifically because the trader lacked strict structural rules that act as that autopilot.
But they had the rules, they just broke them.
If a trader is revenge trading on JD, Baba, and MU, the failure happened long before they clicked the buy button. It happened because their risk controls were not mechanically enforced by their system.
Now, if you're listening to this, you might be thinking, but how do mechanical rules physically stop a human being who has completely lost their temper from just clicking a mouse and buying more shares? I mean, the emotion is the driver of the action.
You stop them by hard-coding the boundaries into the trading platform itself.
Wait, physically locking them out?
Exactly. Predefined daily maximum loss limits, precise entry criteria, time of day restrictions. These are mechanical boundaries that physically prevent overtrading. This is where technology enforces the strategy.
So the software takes over?
Yes. If a trader sets a hard maximum daily loss in their software, the moment they hit that limit, the broker literally locks the account for the remainder of the day. The platform physically stops them from placing another trade.
That relies on them actually setting the lock beforehand, though.
Sure. But if their trade book states that they do not trade certain high-beta tech stocks or recent IPOs, those tickers shouldn't even be loaded on their scanners. You don't need sheer willpower to fight off revenge trading if you've built a structural environment where the bad action is literally impossible to execute.
That is a compelling argument regarding platform controls. I'll give you that. Though I would frame the reality of the situation quite differently.
How so?
Even if you lock the platform, a determined trader in the middle of an emotional spiral will find a way. I mean, they can simply call the broker on the phone to demand the account be unlocked.
That takes time, though.
Or they can just log into a secondary, unregulated offshore account to keep trading. The technological barrier only delays the psychological impulse. It does not cure the disease.
I think you're underestimating the friction a lock provides.
Maybe. But the impulse to overtrade stems from a failure to accept the random nature of market outcomes. When a trader refuses to accept that a loss is just a statistical probability, they perceive that red number on their screen as a personal attack on their intelligence or their worth.
And that triggers the spiral.
Exactly. That perception triggers the biological fight-or-flight response. Your heart rate spikes, your vision narrows, and you act irrationally. You can put all the technological locks you want on a platform, but until the trader reframes their internal belief system to fully accept risk, they will find a way to self-destruct.
But the acceptance of risk is born directly from the mathematics of the trade book. It doesn't come from a meditation cushion.
Oh, come on.
Seriously, let's walk through the actual arithmetic. If my trade book dictates that I risk a strict maximum of 1 to 2% of my total account value per trade, I don't feel a personal attack when the trade goes against me because the loss is mathematically trivial.
Trivial in theory, sure.
Trivial in reality. If I have a $50,000 account and I risk 1%, I am risking $500. If I lose, my account is at $49,500. My ability to continue trading tomorrow is completely unharmed.
Right. Mathematically.
Emotional response, that spiked heart rate and narrowed vision you mentioned, is totally neutralized by the position sizing formula. The math protects the mind.
Okay, well, let's move the conversation over to how traders actually select what assets to trade in the first place, because this phase happens before any position sizing math is even applied.
Asset selection. Okay.
This is where psychology truly dominates the process. Consider the behavioral bias of representativeness. This is a cognitive trap where retail traders make judgments based on superficial similarities, or like stereotypes.
You mean just buying whatever looks shiny?
Essentially, yes. They prioritize stocks based on media attention, social sentiment, or even corporate naming conventions, rather than looking at underlying value or pristine technical setups.
You are talking about traders getting caught up in market mania and just chasing hype.
Exactly. Let's look closely at the historical example of cryptomania to illustrate how powerful this really is. There was a publicly traded company with the ticker symbol LTEA.
The iced tea company?
Yes, they were a traditional iced tea company selling bottled beverages. That was their entire business model. At the absolute peak of the cryptocurrency frenzy, they rebranded to Long Blockchain Corp and changed their ticker symbol to LBCC.
I remember this. It was wild.
They had no underlying blockchain technology, no software developers, nothing, but a new name intended to leverage the frenzy. The stock skyrocketed immediately. Retail traders looking at their scanners saw the volume spike, experienced an intense dopamine rush, and poured their capital into it.
Just pure speculation.
They completely abandoned logic for hype. This represents the fear of missing out, FOMO. You cannot code a scanner to protect a trader from FOMO when the entire market is gripped by a speculative mania.
I disagree entirely.
The ability to observe one's own greed, detach from the herd mentality, and recognize the absolute absurdity of buying an iced tea company for its blockchain potential can defend against that level of behavioral bias.
That is a fascinating historical example, I'll give you that. But have you considered that a rigidly structured asset selection process neutralizes this bias entirely?
How? The ticker was right there on the top gainers list.
A disciplined technical trader operates from a predefined universe of stocks. By maintaining a highly focused watch list of reliable, liquid tickers like $AMD or $NVDA, or by simply tracking broad market movements via an ETF like $SPY, the trader intentionally wears blinders to the media noise.
Blinders?
Yeah, they don't even see the iced tea company on their screens because it's not on their approved list.
But the noise is absolutely everywhere. A trader cannot exist in a vacuum. It is on their social media feeds. It's blaring on the financial news networks in the background. It is the only thing their peer groups and group chats are discussing.
They have to tune it out.
When a human being sees a stock gap up 100% in a single hour, the biological urge to participate is just overwhelming.
Which is exactly why the tradebook dictates the specific instruments allowed for trading. If a technical trader wants to capture extreme volatility or market momentum, they do not need to abandon their system to chase a rebranded iced tea company.
Right, but what do they trade instead?
They use defined, highly liquid instruments built for that exact purpose. For example, they might trade $UVXY, which tracks short-term futures on the VIX, capturing market fear and volatility, or they might trade $NUGT for leveraged exposure to gold miners, or $UGAS for leveraged natural gas movements.
Okay, those are very specific.
Because they are established, regulated vehicles with massive liquidity. If a sudden setup on a stock like $LBCC does not meet the exact non-negotiable criteria of the tradebook, like if it lacks the required minimum average daily volume over the past 30 days, or if the bid-ask spread is too wide, indicating a lack of liquidity, the trade simply doesn't happen.
So the system filters it out.
The asset fails the mechanical filtration process, so the trader bypasses the psychological dilemma altogether.
I'm just not convinced by that line of reasoning because it assumes the trader will always act like an obedient machine, deferring to the mechanical filtration process without any friction.
Well, they should if they want to survive.
But humans are not machines. This brings me to execution and how we actually improve as traders over time. I advocate heavily for psychological journaling as the ultimate tool for trader improvement.
Over technical journaling, tracking the math should always be the priority.
Tracking the mechanics is secondary to tracking the mind because the mind executes the mechanics. Most traders use technical journals to try and fix their strategy, but a psychological journal reveals that your strategy isn't the problem, your nervous system is.
That sounds a bit esoteric.
It's extremely practical. A robust psychological journal requires scaling your internal emotional dimensions on a scale from 1 to 10 before and after every single execution.
Okay, give me an example.
Before you enter the trade, you must rank your confidence, your sense of urgency, and your physical stress levels. After you exit the trade, you track your satisfaction, your level of regret, and your emotional drift.
Emotional drift.
Meaning, did your emotional state elevate into panic or fall into relief during the exact time you held the position.
Honestly, what does scaling your physical stress from 1 to 10 actually solve when you are looking at a price chart?
It identifies the invisible behavioral patterns that are actively destroying your capital. By correlating these emotional scores with your actual trade outcomes, you identify your own impulse loops.
So, turning feelings into data points.
Precisely. For example, you might discover through your journal that a high urgency score consistently correlates with early, unconfirmed entries where you bought before the candlestick actually closed.
I've seen traders do that.
Or you might find that high stress levels consistently correlate with the tendency to exit break-even trades prematurely before they reach their statistical profit target. The journal elevates your self-awareness, revealing a profound truth. You aren't actually trading the market. You are trading your own need for emotional comfort.
I have to push back hard here. How can a trader accurately evaluate their emotional state if the underlying mathematics of their trades are fundamentally flawed?
The math doesn't cause the stress. The uncertainty does.
If you are feeling stressed and your heart rate is elevated, it is highly likely because your technical setup lacks a proven statistical edge. A journal must prioritize specific, quantifiable technical execution metrics to be of any real value.
Walk me through what you consider the priority for a journal then. I mean, how does tracking the math solve the stress?
You need to ask objective, mathematically verifiable questions in your journal. For instance, was a 1-minute opening range breakout executed correctly according to the trade book?
Okay, the 1-minute ORB.
Yes, and for those listening who might not trade this specific setup, a 1-minute opening range breakout involves identifying the absolute high and the absolute low of the very first minute of the trading day and executing a trade when the price breaks those boundaries.
Very standard momentum play.
Exactly. So your journal asks, did the 1-minute candlestick close definitively above the volume-weighted average price, the VWAP?
Right. The volume-weighted average price.
The VWAP represents the true average price of the stock based on the total volume traded. It is an institutional anchor. Was the stop loss placed exactly at the VWAP, where the institutional math dictates the trend is broken, or was it placed arbitrarily based on how much money the trader personally wanted to lose?
Which happens all the time.
These are binary mathematical realities. You either followed the math or you didn't.
But placing a stop loss, even at a logical level, like the VWAP, is an intensely emotional act for many retail traders. They manually move the stop loss down as the price approaches it because they fear taking the loss and want to give the trade, more room to work.
They move it because they don't have a mathematical anchor, proving their edge over time. The math of risk management provides the objective reality that emotions so often obscure.
I don't know about that.
Listen, if your technical journal proves with hard data that your 1-minute opening range breakout setup has a verifiable 60% win rate over a sample size of 100 trades, and your risk-to-reward ratio is strictly maintained by risking only 1 to 2% of your account per trade, you literally stop feeling fear.
That is a huge assumption.
The anxiety disappears not because you sat and meditated on your urgency levels, but because the empirical data proves your edge will play out in your favor over time. You simply cannot journal your way out of a negative expectancy model.
Let me challenge that directly, because I have seen the exact opposite play out on trading desks. I mean, I have seen highly experienced traders, individuals who know their metrics cold, who understand their exact win rate and risk-to-reward ratio down to the decimal point, still freeze in live markets.
Even with a proven edge?
Yes, they see the 1-minute opening range breakout forming perfectly right at the VWAP. Their trade book is screaming at them to execute. The math is pristine, but they hesitate.
Why?
They suffer from performance anxiety, or they have a flashing memory of a painful loss from the previous day, and their finger just hovers over the mouse. They miss the entry entirely. That hesitation loop is entirely cognitive. The math is perfect, but the mind simply refuses to pull the trigger.
That is a valid scenario, and hesitation is a real phenomenon. But the cure for that hesitation is leaning harder into the mathematical system, not dwelling on the emotional state.
How so?
When a trader hesitates, it is almost always because they are judging the potential outcome of that individual isolated trade rather than thinking in probabilities over a long series of trades.
Right. Mark Douglas talks about this.
Exactly. The late trading psychologist Mark Douglas addresses this perfectly. When you train yourself to view trading as a block of 20 executions, The outcome of any single execution within that block becomes mathematically irrelevant. The tradebook provides the rigid architecture required to execute that series of 20 trades without requiring a daily psychological evaluation.
But realizing you need to think in a series of 20 executions is in itself a profound psychological realization. A written framework alone cannot force a human nervous system to detach from the pain of an immediate financial loss.
It takes practice.
To reach that state of detachment where you can effortlessly execute 20 trades without flinching, you must actively master your mind. You have to genuinely accept the random distribution of wins and losses. You have to develop the self-awareness to recognize when you are operating out of FOMO or when you are tilting toward revenge, and consciously step away from the terminal.
And I maintain that a defined technical edge and the strict mechanical rules of a tradebook provide the necessary architecture for any of that psychological discipline to actually function in reality. Without the rules, the psychology is just philosophy. The strategy dictates the survival.
Well, controlling those internal impulses remains the ultimate deciding factor for navigating market uncertainty over a lifetime. We have thoroughly explored both sides of this dynamic today. The concepts we examined clearly point toward a necessary synthesis for anyone looking to build a career in this space, which is often termed the trilogy of success.
Exactly. Technology, strategy, and psychology, they must operate in tandem. If you lack the rigorous strategy, your psychology has no framework to operate within. If you lack the psychology, your flawless strategy will inevitably be abandoned the moment pressure is applied.
They form a complete, interdependent ecosystem. We encourage you, the listener, to explore these concepts further to refine your own methodology, as there is always more to examine when it comes to mastering the markets. The next time you find yourself staring at a chart, ask yourself if it is your strategy feeling or your mind. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.